Most investors try to eliminate uncertainty. They want clarity, they want confirmation, they want prediction. But markets are uncertain by design, and the investors who survive long enough to compound wealth are not the ones who predict best. They are the ones who structure exposure correctly. That structure is called convexity. 1. Linear thinking in a nonlinear system. Humans think linearly. If growth increases, prices rise. If earnings beat, stocks go up. If rates fall, equities rally. But markets are nonlinear systems. Small shocks can trigger massive moves. Liquidity can disappear suddenly. Correlations can converge during stress. In 2008, assets that were considered diversified collapsed together. In March of 2020, even high-quality assets were sold indiscriminately. Not because fundamentals vanished overnight, because liquidity did. If your portfolio assumes smooth continuation, it is fragile. Convexity is how you survive nonlinearity. DV. Convex versus concave payoffs. A convex payoff structure looks like this. Limited downside, expanding upside. A concave structure looks like this. Limited upside, expanding downside. Most investors unintentionally build concave portfolios. Examples: selling volatility for steady income, leveraged carry trades, yield chasing, over-concentrated high beta growth. These strategies produce frequent small gains until one extreme event wipes out years of performance. That's negative convexity. Convexity is different. You accept small defined losses in exchange for occasional large gains. It feels inefficient. It feels wrong most of the time, but it survives tail events. 3. The mathematics of tail risk. Markets do not follow neat, normal distributions. Extreme events happen more often than most models predict. If you design your portfolio assuming extreme events are rare anomalies, you are underpricing risk. Convex portfolios assume tails will happen. They are not surprised by volatility spikes. They are positioned to either survive them or benefit from them. Concave portfolios appear stable in normal conditions, but they are structurally exposed to tail risk, and tails are what destroy compounding. 4. Optionality as strategic advantage. Optionality means having the right, not the obligation, to act. In practical terms, cash is optionality. Low leverage is optionality. Liquidity is optionality. During crises, forced sellers appear. Assets misprice. Fear dominates. In those moments, most participants are reacting. The few with liquidity are acting. Optionality turns chaos into opportunity. Without optionality, volatility is threat. With optionality, volatility is inventory. 5. Convexity is not just about options. Convexity does not require complex derivatives. It can be built structurally. For example, small position sizes and asymmetric ideas, defined downside before entering a trade, avoiding unlimited risk strategies, maintaining liquidity buffers, avoiding excessive leverage. Convexity is about structure, not speculation. It's about ensuring no single mistake is fatal. 6. The psychological barrier. Convexity is emotionally difficult. You may underperform during strong bull markets, experience small losses repeatedly, feel too cautious. Humans prefer high win rates, even if the payoff structure is dangerous. That's why concave strategies are attractive. They feel competent until they break. Convexity requires tolerance for looking wrong in the short term, but markets are long-term survival games. 7. Convexity and compounding. Here's the deeper truth. Compounding requires continuity. Continuity requires survival. Survival requires limited downside. If your structure allows a 60% drawdown, you don't just lose money. You lose time. And time is the real compounding asset. Convexity protects time. It prevents catastrophic interruptions. It keeps you in the game. 8. Convexity versus fragility. the anti-fragile layer. There's an important distinction between being resilient and being anti-fragile. Resilience means you survive shocks. Anti-fragility means you benefit from them. A fragile portfolio suffers from volatility. A resilient portfolio survives volatility. A convex portfolio can benefit from volatility. Think about volatility spikes. For many traders, volatility means stress, forced liquidation, and large losses. For a convex structure, volatility expands opportunity. Why? Because convexity benefits from asymmetry. When price moves accelerate, convex exposure expands nonlinearly. That's the structural advantage. You're not trying to avoid disorder, you are positioned so disorder cannot destroy you. And occasionally, disorder helps you. 9. A historical illustration. Consider investors who were heavily leveraged going into 2008. They had steady returns for years, low volatility, strong income, smooth compounding. But the structure was concave. When liquidity evaporated, losses accelerated. Leverage amplified downside. Margin calls forced liquidation. Recovery was not a question of being right, it was a question of survival. Now compare that with investors who held liquidity, avoided leverage, maintained small asymmetric positions. They did not predict the crisis, but they were structured to survive it, and survival created opportunity. The difference was not intelligence, it was payoff structure. Final 3 takeaways. First, smooth returns often hide hidden fragility. Second, optionality requires liquidity, discipline, and patience. Third, in markets, survival is more powerful than prediction. The goal is not to eliminate uncertainty, it is to structure exposure so that uncertainty does not eliminate you.